India has just given us the clearest signal we needed to confirm what we've long suspected. A major disruption of Black Swan event is looming. Our instincts were right, and the signs we've been tracking are aligning with unsettling precision. There's a sense of unease in the air, something foreboding, and yet necessary. This upcoming turmoil, while uncomfortable, might be exactly what we need to break through current stagnation and reach even greater economic heights. But before diving deeper, let's address an ongoing tension that reflects a broader conflict. Former President Trump continues to claim he understands market behavior better than Federal Reserve Chair Jerome Powell. This ongoing clash reveals Trump's push for a more aggressive, market-stimulating stance, while the Fed remains conservative and cautious. All eyes are now on the upcoming FOMC meeting on May 7, just a week away, which will be pivotal in determining the market's next move. Whether the market takes a leap forward, tumbles backward, or drifts sideways will hinge on what's decided at that meeting. Personally, I lean bearish right now, especially considering the current federal funds rate sits in the 25% to 50% range and is likely to stay unchanged for now. Still, I strongly believe that we'll see a rate cut in June, triggered not by policy preference, but by the sudden arrival of a destabilizing Black Swan event, an unpredictable shock powerful enough to collapse markets by 50% or more. After that, the government may respond by printing as much as $30 trillion in new currency, desperate to stabilize the fallout. Something about today felt different, as if we were standing on the edge of a precipice. Notably, state banks are showing signs of extreme stress, with $482 billion in unrealized losses, up 33% from the previous quarter. It's as if the financial system is quietly cracking beneath the surface. While headlines have recently touted April as the worst stock market month since the Great Depression, and then quickly contradicted themselves by noting the Nasdaq ended the month positive, this inconsistency only adds to the sense of unreliability in official narratives. These market rallies may simply be dead cat bounces, temporary recoveries before deeper plunges. I've already shared my predictions on social media. The Dow Jones will likely fall to the 33,000 range, maybe lower. Technical patterns suggest a bottom forming near that level, a support line that's held before. Afterward, another round of money printing will probably be unleashed. India's sudden and notable involvement in the geopolitical economic narrative adds another layer of intrigue. As Warren Buffett has wisely cautioned, anyone investing in stocks or, especially cryptocurrencies, should be prepared for drops of 50% or more. If equities fall by 50%, expect crypto to plunge by as much as 70% or more. These potential losses mirror the 40% drop the Dow experienced in 2020, showing that the floor can fall out quickly. So, if a collapse takes stocks down 70%, 90%, we may already be halfway there. Whether the Dow's bottom lands at 33K, 30K, or even lower, it appears we're approaching a critical turning point. When the government inevitably steps in with massive liquidity injections, the downward spiral might accelerate before recovery begins. Ultimately, Buffett's philosophy remains sound: invest only if you're mentally and financially ready to hold long-term, ignoring short-term noise, just as a farmer doesn't obsess over every day's weather. Keep in mind that this man has billions in cash, ready to deploy once prices hit rock bottom. The reason he's not making a move right now is likely because he's waiting for the market to truly collapse to reach its lowest point. It's clear that a major decline is expected, and he's probably planning to deploy capital once that bottom is reached. But it's crucial to understand that trying to perfectly time the bottom of a market is a flawed strategy. No one can do it consistently, and you shouldn't rely on anyone else to do it for you. When you buy a stock, you should anticipate that its price might fall by as much as 50%, and you should be mentally prepared to endure that drop as long as you have confidence in what you're holding. Warren Buffett even mentioned in one of his annual letters, perhaps the one from a year or two ago, that Berkshire Hathaway stock has experienced 50% drops 3 different times in its history. Yet each time the business remained fundamentally sound. The danger lies in owning stocks with borrowed money during such drops. Margin calls could wipe you out. The key point is that price fluctuations alone shouldn't dictate your investment decisions unless you're reacting to truly new and material information. It's tempting to chase whatever is going up, but real discipline lies in sticking with your plan even when others are jumping ship. The ability to stay calm and rational during downturns is what separates great investors from the rest. Some people are naturally better equipped to handle the mental stress that comes with market volatility. Buffett and Munger, for example, have never really feared losing money. If you have that kind of mental fortitude, you can afford to hold long-term positions, understanding that you're not going to get constant validation from others. You need your own conviction, because without it, the next person you talk to might shake your resolve. That's why you have to invest based on what you deeply understand and believe in. Holding through chaos requires clarity and inner strength. As for whether now is a good time to buy, nobody really knows. Short-term outcomes are unpredictable. You could lose ground in the next couple of years, even if your investment is sound over the long haul. Buffett has said that while the next 20 or 30 years might bring great results, the next two are a coin toss. And now, to complicate things, economic pressure is mounting. For example, Adidas is preparing to hike prices on unisex products due to tariffs. Markets are inflated, and the volatility doesn't seem to be slowing down. On top of all that, we're seeing geopolitical tensions rise rapidly. Just a couple of hours ago, Pakistan's military claimed that India is planning an attack within the next 24 to 36 hours. This is the kind of unpredictable news that can send markets spiraling and cause panic. It's moments like this that confirm how fragile and reactive everything is. And while some of us saw something like this coming, it still feels shocking when it actually hits. It's a reminder that risk can come from anywhere, not just from numbers and charts, but from real-world events that blindside everyone. Now the situation feels even more intense, with Pakistan making it clear that its military is not just for show. After more than a century of defense buildup aimed at a specific adversary, tensions are on a knife's edge. This is the kind of backdrop that makes markets not only volatile, but emotionally overwhelming. It's exactly why steady minds are needed, not just to survive, but to find opportunities amid the chaos.